As an investor, what is your take on what we're seeing?
Yeah, so given where we are in this development, and as Steve noted, I mean, it's been a wild couple of days. I'm not sure I'm not sure how much more I can add to what Steve is saying. I think the reality is that Microsoft's in a tough spot. I mean, they've spent well north of 10 billion investing in OpenAI so that they could have access to ChatGPT early on, so they could fold it into this pivot at Microsoft, which is focusing more on generative AI across its suite of products. So, Nadella says they're still committed to OpenAI, but at the same time, you have the two chiefs leading that enterprise now coming into Microsoft. And I'm sure over the next several days, weeks, months, we're going to hear about brain drain away from OpenAI and to Microsoft's new internal AI research lab headed by Sam Altman. So point is, they're still in bed. They, meaning Microsoft, are still in bed with OpenAI. They still remain committed. They have a major financial backing there. But at the same time, it feels like they are trying to bring in-house now the capabilities that they had with ChatGPT. So it's going to be really interesting to see where it goes from here.
So as an investor, it sounds like you're in favor of that move to bring Sam Altman in-house, Brockman in-house.
I'm not. I don't know. I'm not sure that I would say I'm in favor of it. I don't know what other move they had.
All right, Jason, stick around. We want to pivot ourselves now to another big story in the media space. Today marks 1 year since Bob Iger came out of retirement to lead Disney again, following the firing of his handpicked successor, Bob Chapek. Iger's first run as CEO, it just vaulted him to the Mount Rushmore of top executives of all time, overseeing the acquisitions of Pixar, Marvel, Lucasfilm, and Fox, plus the launch of Disney+. But Iger suffered several setbacks in his first year back at the helm. That includes, but not limited to, Disney+ still losing money. The movie division has seen a string of box office bombs, activist pressure, and even Disney World is reporting lower attendance. Shares, they're basically flat since Iger's return. Jason Ware is still with us. Let's also welcome in CNBC.com media and technology reporter Alex Sherman. Alex, thank you for joining the conversation right now. I want to get a sense. We're at the 1 year anniversary right now. What's your take of this 1 year of Bob Iger being back as CEO?
2023, I would say, is the year that Bob Iger and Disney declared to the world that something is wrong with the company. That's sort of the defining theme throughout the year. Maybe 2024 will be the year that Disney figures out really what it wants to do in terms of moving forward as a company. But 2023 was largely defined by significant job cuts, a significant pullback in content spend. Disney eliminated 7,000 jobs. It originally set a target of eliminating $5.5 billion in cuts. Just this past quarter, Bob Iger upped that number to $7.5 billion in cuts. But strategically, we still don't really know the direction of Disney moving forward. Bob Iger has thrown a lot of different solutions out there. It could sell ABC. It could find strategic partners for ESPN. It could spin off or sell the linear cable networks. But we don't exactly know what direction he's going to choose. So we'll see if 2024 is the year that we actually find out the answers to some of those questions. And maybe 2025 is the year that we start talking about Bob Iger and succession.
All right, so Alex, a lot of questions, it seems, across the board. Jason, I want to come back to you. You are a Disney shareholder, one of your top 10 holdings. How do you view this year of Bob Iger being back at the helm of Disney?
Yeah, I mean, like Alex shared, I mean, Bob Iger has been very clear on this, including the last conference call, that this first year has been a fixing year, and now they're pivoting toward building the company again. And a lot of that fixing was, refocusing away from what the other Bob Chapek was doing, which was just focusing on subscriber growth at any cost for Disney+. Their direct-to-consumer model has been losing money for some time because of high content costs, low average revenue per user, and just this focus on bringing people to the Disney+ platform. And look, they were very successful. But now Bob Iger's job is to turn that to profitability. And I think he's doing a really good job. I mean, we were at 1.5 billion in operating losses when he took over a year ago. We're now getting close to 300 million in operating losses, probably going to be flat here as we get into the second half of 24. So shifting that DTC Disney Plus away from subscriber focus and over to profitability is important. Bob Iger is also very focused on reinvesting and turbocharging, as they're calling it, their experiences business, which of course includes their theme parks, resorts, merch, and all of those important elements to the Disney brand. So look, I think Bob Iger's done a good job. I give him a B+ in this first year. The stock's flat, but he's taking costs out, as Alex mentioned. He's refocusing on the next wave of growth for Disney. The linear networks, that's still a cash flow type of business. Right. I don't think there's a lot of growth there. They recognize that. They're looking to do something with that. But the areas they're looking to focus on, they're moving, and we as shareholders celebrate that.
All right, so you go. B+ from Jason Ware on Bob Iger's first year back as the CEO. Alex, I want to come over to you. You've done a lot of great writing on this topic of Bob Iger retaking the helm, and also the idea that there isn't quite yet a succession plan. Give us a sense. The succession plan, is that one of the top priorities for 2024? Is there something else that needs to be handled even before then, just to give a boost to the stock price and to investors?
Look, if 2023 was about taking out cost of the business and sort of refocusing the business on profitability, I think 2024, the real focus of 2024, needs to be, well, does this strategy really resonate with investors? Because we haven't really seen the same leg up in Disney shares that we saw during the pandemic, when Disney had a real growth story, when they could clearly say, look at all these new Disney Plus subscribers. Look at this new business we have. There is no new business yet. Theme parks continues to be a good story, but that's an old story. So before succession, I think it's Iger's job to position Disney in a way where investors can get excited about putting their money in the stock. Then I think maybe early 2025 is when I think Disney will start talking about succession, and maybe this year will be spent on Iger choosing who that person might be. Of course, there are definitely cynics out there who think Bob Iger will just continue to kick the can down the road indefinitely and stay as Disney CEO for literally as long as he can, because this is clearly a job that he loves and the board has confidence in him. Remember, he has pushed back his retirement 5 different times since he has become the CEO. So just because the plan might be for him to leave at the end of 2026, we all know that that may not actually come to fruition.
Alex, again, you've done a lot of great writing on this topic. You're bringing up something, basically Bob Iger changing his mind about a few things. There was reports out there that he wasn't in love with Hulu, and then Disney buys the full share of Hulu from Comcast, our parent company. We've heard other things, that maybe he wants to spin off the traditional TV business of the ABC networks, and then, the company comes out and says, well, maybe not. We're just exploring. Are any of these things that we heard about, how much should investors really put faith in them as far as spinning off the TV business or making other moves in the company?
Look, it's a difficult time right now to do any transactions, particularly in this business. Valuations are low. There aren't many private equity buyers out there because interest rates are high. So they're going to, for anyone that wants to put a decent amount of debt on an asset that is declining, they're going to have to raise money at a fairly high interest rate if they don't have the dry powder available. So it's tough. We'll see if the environment changes in 2024 and becomes more friendly to media deals. From a regulatory standpoint, though, that's still a hurdle, certainly in terms of strategic transactions. So I think Disney has used this year to kind of figure out what's possible. Based on the rhetoric around what Bob Iger has said recently, it seems as though he is hinting that a deal to find strategic partners for ESPN could very well happen next year. He seems more bullish on that one. In terms of selling ABC or the linear networks, his most recent commentary during this past earnings call, to me, suggested he's pulling back on that idea. He may have felt that one around a little bit and realized the market just wasn't there. So I would not be surprised if he ended up keeping ABC, despite kind of throwing it out there that was on the table. Hulu is probably a done deal at this point. That's just a matter of getting that price agreement with Comcast to take in that remaining 1/3. So that is a transaction that I do think will be done sooner than all the other ones, where the entirety of Hulu comes in to Disney, and then Disney can start to use Hulu in a more international way rather than just a domestic service.